My name's Mark Stubbings and I've got the pleasure to be your host again today. And welcome along to episode 2 in our Asset Deep Dive webcast series. If by chance you missed our last broadcast, which is approximately a week and a half ago, on the property asset class, there's a link on our website, or alternatively contact our business development team and we'd be happy to get a recording to you. This webcast today, and indeed the whole series, are very much designed for financial advisors, dealer groups and obviously other participants in the industry. And the whole idea behind the Deep Dive series is to give an insight update into the Sunsuper asset classes. We want to talk about the objectives, the construction, the holdings and also the performance. We're also very, very committed to being open and transparent. We think that's particularly important for you and your clients during these very difficult times. After this one, we still have 3 webcasts to go over the intervening 5 to 6 weeks, and we'll be concentrating on private capital, alternative strategies, and also our equity holdings, including the index options. But today, as I mentioned, we're looking at infrastructure. And give you a little bit of an idea of today's agenda. I'm going to be joined very shortly by Andrew Robinson, who is our portfolio manager for infrastructure. Andrew's going to start off with a short presentation which will give a good grounding for the asset class. And then we're going to turn to our questions. And we have obviously a live webcast today, and so we'd literally welcome your live questions, and we already have some already that we've curated. If you want to submit a question, please have a look at the speech bubble on the bottom right hand side of your screen. We'll try our best to get through those questions, but if not, you're more than welcome to revert to our business development team. We can follow those up. And we are very fortunate as well. We've got Will Burke here today, and Will be helping curate the questions so that we can obviously present them to Andrew. I am required obviously to go through the disclaimer, and please be aware that obviously for legal purposes what we share today is general information, and it doesn't obviously take into account any person's personal situation or goals. So let me introduce our speaker. Andrew Robinson, who I mentioned is our portfolio manager for infrastructure. Andrew joined Sunsuper in 2011 and he's been in his current role since 2016. His responsibilities are pretty broad, but they cover portfolio construction, investment research and selection, ongoing reviews, reporting of funds, and obviously direct and co-investment opportunities in Australia and globally. Andrew's had 20 years in the industry, and of that 20 years, 8 years was spent at Deloitte in the corporate finance area, and Andrew was heavily involved with merger acquisitions, valuations for both public and private companies in Australia, the UK and Switzerland. Andrew has a bachelor in business qualification, finance and accounting, and he's also a member of the Institute of Chartered Accountants, Australia and New Zealand. So without any further ado, I'll now pass over to Andrew Robinson.
Many thanks for that introduction there, Mark. I appreciate the opportunity to talk to you today. As at 31 March, Sunsuper had just over $5 billion invested into infrastructure. Across our 4 main diversified options, the allocation ranges between 5.5% and 8.5%, and our balanced option has a 7.5% allocation. There's always an interesting question about what actually is infrastructure. And to be honest, in our strategy documents, we don't say exactly what it is either. It's not defined specifically. But instead, we have a set of characteristics that we look for, and I've got them listed here. The long duration, large initial capital outlays, monopolistic qualities, stable income, GDP or inflation linkages, and long-term contracts. And for us, infrastructure doesn't have to have all of those characteristics, but the more that it has, the more likely that we do consider it to be infrastructure. We list some examples on the side. These are common infrastructure assets, but I would say that the definition of infrastructure is getting broader over time, and this is something you actually need to be careful of. What some people would call infrastructure is not what we would call infrastructure. Some people take much more risk than us, early stage development, lack of yield, and to us that's more private equity, so different characteristics than the low risk approach we take. If we move on to the next slide, we really go on to talk about how we invest into infrastructure. So we've identified what we consider to be the best managers there are in the market, and we invest with them about 75% direct and 25% into pooled funds. Investments can take the form of either listed equities, unlisted equities or debt. We consider the listed equities and debt to be more of an opportunistic, and we really focus on that unlisted side of things. Now, I really want to emphasise that we are low risk. We do focus on the core and core plus infrastructure. We're really looking for yield and also have conservative leverage. Only about 35%, the average gearing across our portfolio is only about 35%. Governance is a critical consideration for us. We are always looking for board representation. With that, we can influence the direction of the company and drive additional value for our members. And last point there is that we believe in active management for the portfolio. We retain full discretion over all of the direct investments we make. We don't just rely on managers to do that for us. Over the long term, we think of infrastructure as being half defensive and half growth. So we think about it as having fixed income-like characteristics. We should get a bit of upside for the equities and be able to capture an illiquidity premium. And that's really our strategic benchmark, half equities and half bonds. Because we're low risk, it should yield about 4 to 5%. And over the long term, we're expecting about an 8.5% return for infrastructure. In the short term, I would expect we could do a little bit better than that, however. If we move on to the next slide, we go into a little bit about the portfolio diversification. You can see here we have got a diversified mix of assets in the portfolio. It is a combination of those core plus assets, which tend to be more GDP correlated, like your airports and ports, and core assets, which are more the regulated utilities, lower risk type assets. And we have assets in between. Probably the better slide shows the next one, which really shows the diversification of the portfolio. And this is the first time we've presented this slide. Hopefully it adds value. What is really showing geographically how diversified we are. We have about just over 50 assets in the portfolio. The direct investments are the dots in orange, and they tend to be a little bit larger. The blue dots are the assets which we hold indirectly through the funds that we invest in. And as I mentioned, we are lower risk, so we have really focused on the lower risk OECD countries. Australia makes up about 45% of the portfolio. Europe 40%, and North America 15%. The most exotic direct holding we have in the portfolio is an asset in the Czech Republic. While the Czech Republic might cause concerns, it is a core regulated asset and it's actually been one of our best performers since we've held that asset. You would also notice that we do lack the emerging markets in our portfolio. There's two reasons for that. First one is fees. It tends to be more expensive to go into those markets. We are really trying to keep the fees low as possible and give more returns back to our members. Secondly, it's often higher risk going into these markets. You are taking on more risks, and for us, we're just not quite sure whether the risk-return trade-off is there. If we go on to the next slide, this is the last one of the formal presentation here, and we'll pause on this one for a minute. I'll explain it. That top line there, this is the return of Sunsuper's infrastructure portfolio over the last 5 years. I mentioned earlier that we do think of infrastructure being defensive in growth, and we effectively take our money from equities and bonds. So that bottom line is a public market return mix of 50-50 equities and bonds. You can see over the last 5 years we've had significant outperformance against that bottom line. So by being able to invest in these alternative asset classes, we have been able to capture that illiquidity premium and drive additional value for our members. Now the line in the middle there is also quite interesting. There is a listed infrastructure index out there, and that is a return of the listed infrastructure index over the last 5 years. You can see that, again, we've significantly outperformed that, so we have been able to capture that illiquidity premium. But not only that, we've been able to do it at lower volatility as well. So why do we have lower volatility in unlisted infrastructure? It really is that the market does tend to overreact, and a lot of stocks move with market sentiment. Taking a longer term approach, periodic valuations, we don't have that volatility. So if you look in the last few months or the first few months of this year, you can see the massive drop there was in the listed infrastructure index there, and have rebounded about half of that shortly thereafter. You look at our returns, there is a drop, but it's more stable. The drop isn't as big. But when you look at what happened at the end of it through 2019, that listed infrastructure index had a capital return of just over 20%. Our index had more of a comparable return of only 9%. So we don't have those massive spikes on the upside, and at the same time we don't have the massive drops either. And that's really why we like investing in unlisted infrastructure. It can deliver you both higher returns and also deliver you lower risk in the form of lower volatility. There is one other thing which I wasn't able to put up here because of licensing reasons. There is an unlisted infrastructure index as well. This contains the IFM funds, UTA, TIF, a number of other funds. It is common for our peers to invest in. Over the last 5 years, we've actually outperformed that by about 2.8% per annum. So compounded just under 15% over the last 5 years, we've outperformed our peers, which is something we're very proud of. I'll probably pause right there, Mark, and just hand back over to you.
Andrew, and we already have some questions that have come in prior to this, and then we'll actually deal with some live ones as well. But some of the questions we've had already, Andrew, and the first one's a bit of a double barrel question, so I can hit you with that. So, Andrew, what does the due diligence process for buying an infrastructure asset look like? And second part is, and what do we look for?
Sure. Look, hopefully we've got the slide of Long Beach Container Terminals we can put up, and this is our most recent investment. The largest port in the US is Los Angeles and Long Beach. There's multiple terminals, and we've just bought an interest in one of these terminals. But I'll just take a quick step back first and talk about our process. As I talked about, we have our managers we work with in partnership with, and we see about 70 to 80 opportunities a year from these managers. Of these opportunities, we do desktop work on maybe 10 to 12. That's a week or two's worth of work. We'll do full due diligence on 4 to 5, and which I'll talk about that process shortly. And if we're lucky, we'll invest into 1 to 2 assets a year, and that's it. So yes, it is a lot of work to get to 1 to 2 assets, but we are deploying $200 to $600 million per investment. So we do need to do a lot of work and be very careful with our members' money. What I'll say is that we are very thorough with our DD process. We don't just rely on our managers to do the investments for us. We have 3 sets of eyes looking at every opportunity. Our managers do their due diligence. We also work with Jana very closely, who do due diligence on an opportunity, and we need to do our own as well. And for us to actually put anything up to our investment committee, we need all 3 of those parties to give a positive recommendation. So what's the process look like? We as a team within Sunsuper, we look at every single DD report. We spend weeks looking at these. I'll normally end up with a pile about 6 inches high of paper on my desk that I need to get through. We will pour over financial models and sensitize them. We will negotiate legal documents. We will engage with financial advisors. So it is a very hands-on process that we are doing the work ourselves. And that process can take up to 6 months. Looking at Long Beach Container Terminals here, this was probably about a 2 to 3 month process, this one. We started work in, I'm going to say, late September, working from Australia, going through all that material. By early December, we'd done most of our work. We thought it was prudent to go and meet the management team as well. So myself, Naomi and our team, and Brian Parker, our chief economist, all went over to the US, spent time with the management. It was great having Brian there. He could interrogate them on their economic assumptions and forecasts and trade volumes. We also got to wander around the site here. These cranes here are massive. They're actually about 30 stories high, and we went to the top of those as well. Being afraid of heights myself, it was a little bit of a challenge, but managed to get through it, thank God. So it is a very thorough process that we do spend, and it was great to go and meet the management and get additional comfort that they are aligned and committed, and the business plan we're working towards is going to be deliverable. You asked about what we look for. It is not just about the returns of an asset that we look at. I spend massive amounts of my time looking at the risks and what can actually go wrong. It is very hard to make a bit of extra upside on any asset, but it's very easy to lose money. So looking at those downside protections are critical to us. So when we were doing DD on this opportunity, COVID-19 had started, but it hadn't really taken off. Our base case was that there was going to be a recession in the first 2 years after we bought this asset. So we thought to be more conservative. There were some concerns, a two-year recession. Look, I'm very glad we did take that position. As a consequence of taking that conservative position, we're actually outperforming our base case, despite the headwinds being faced to global trade as a consequence of COVID-19.
That's an excellent story. Thanks, Andrew. Now, the next question is a very high-profile one because obviously the asset's very high-profile, or the group. Given our exposure to airports, what has been the impact from COVID-19? And double-barrel question again. And what does the road to recovery look like, Andrew?
Let's look at a slide of Brisbane Airport we can put up there. You'll notice a brand new runway on the right, which is due to be opened in July, but you'll also notice a bunch of planes parked down in the front of the screen here. What I'd say is that we have been long-term investors into airports. Since 1997 we've held the airport, so we understand the space extremely well. And there's no question about it, airports are facing massive headwinds at the moment. Passenger numbers are negligible, our revenues are down a lot, but fortunately EBITDA isn't down as much. There are costs we can minimise and take out. And the other thing you have to appreciate about airports, say Brisbane Airport for example, is that it is a diversified revenue stream. Brisbane Airport is actually 2,700 hectares of land. You don't really appreciate how big it is. Yes, you've got the main terminal, the runways, but there's a massive land bank. And the management team's done a very good job of building out that land bank. There's a lot of industrial property, there's a shopping centre, there's a duty-free outlet, there's an auto mall being built, there is consideration of a golf driving range. So that really diversifies the revenue base and gives some protections for a shock, which is really a 1 in 100 year shock, which is occurring today. With all these headwinds, rest assured that we have factored these into the valuations already. We actually did out of cycle valuations for all of our assets as at March. A number of assets, including our airports, we did additional valuations at April, and we even did another valuation at May. So we have updated these headwinds into the valuations, and as the situation evolves, we'll adjust the forecast accordingly. But historically, airports have rebounded very well from these types of shocks, from SARS to the Ansett collapse to the GFC. Within 2 years, they've typically been back to their pre-crisis levels. How do we see the road to recovery today? We're actually seeing, we're expecting a bit more of a protracted recovery for the airports today. Yes, we think demand for travel for business and leisure will remain, but we're expecting more of a 4 to 5 year recovery to get back to 2019 levels. We still really do see airports to be as attractive investment opportunity. When we look at them, they still do retain those very strong infrastructure characteristics. They are monopolies. There's really no alternative if you want to go overseas. There's large capital outlays which make a barrier to entry. There's those GDP and inflation linkages which will benefit from any recovery going forward. So where we sit now, we expect long-term our airports will still continue to deliver high single-digit to low double-digit returns well into the future.
Excellent. Thanks, Andrew. And last question, and again double-barreled, is Sunsuper looking to further invest in infrastructure? And generally, how does the future look for this asset class, Andrew?
Look, as a growing superannuation fund, we are always looking to buy more investments. We have grown this infrastructure portfolio from $700 million 9 years ago to $5 billion today. Over the next 5 to 6 years, we need to grow that to $9 billion. So yes, always looking at opportunities. What have we been looking at lately? We have been looking at gas pipelines in Portugal. There's actually some here for sale in Australia as well, which we've been considering. There are renewables in the US where we're spending a little bit of time on. We've been looking at telco towers here in Australia, some mobile phone towers. Data centres has been another focus area, and we're doing a bit of deep dive on that sector at the moment. So there are a broad range of opportunities for us. Where do we see the direction of infrastructure? With infrastructure, in my opinion, has moved from an alternative to a mainstream asset class, but there is a huge wall of capital still trying to deploy into this space. So as more capital comes in, it will continue to push prices up and returns down even further. We think with the way that cash rates are and bond rates are, how low they are likely to be low for a long time. we just don't see that changing anytime soon. What I will say is that for us, what is important about is to be patient, to remain disciplined and don't overpay for assets. That's critical. If it takes a while for us to deploy more capital into another asset, that's fine. I prefer to wait a bit of time and buy the right asset than just get capital deployed and potentially lose our members' money.
Excellent. Thank you, Andrew. And now what we're going to do is cross over to Will for some submitted and live questions. So Will, what have you got first up for us?
Thank you, Mark. And there's a number of questions that have come in regarding valuations. So we might spend a little bit of time on that if that's okay, Andrew. So the first question is, valuations are opaque. Who values your infrastructure portfolio and on what basis are they valued?
Yeah, look, really happy to go into this one. You do read in the press about valuations of unlisted assets being opaque. Clearly the industry hasn't done a good job explaining the process, so hopefully I can clarify that today. What I would start by saying is it is really an independent process. We don't seek to influence the valuations. Who do we work with to do valuations? Most of the time it's the big four accounting firms. They always have a corporate finance area, and within that they have a specialist valuation team whose only job really is to value businesses for M&A or for reporting purposes or for superannuation funds. Highly knowledgeable people, constantly looking at transactions, and they know what these assets are trading for. We appoint them for typically a 3-year term. Why 3 years? Because we want to rotate the valuers to get a fresh set of eyes on things, make sure there's no entrenchment in the valuation. And valuations are done every 3 to 6 months, so they're periodic valuations. The process of actually doing a valuation takes between 5 and 6 weeks normally. It normally starts with the management team of the asset. They come up with their own long-term business plan, typically a 10 or a 20-year model, some of them are even longer. And it's pretty common for the management team of our assets to get independent advice when they're building their forecasts. So Tourism Futures International is a common advisor used to by many of the airports to help forecast where passenger numbers are going to go going forward. They build those into their model, so they independently produce their own long-term business plan, which they work towards. They give that to the valuers. As I said, the valuers are experts. They look at these things all the time and they review those forecasts. And they might sensitize those models. They might adjust for assumptions that they think are either too aggressive or too conservative. And then they will come up with a discount rate to value those assets. Once they value them on discounted cash flow, they always use a secondary method to value the assets. Typically an earnings multiple is the common way to do that. So how do they know what appropriate discount rate? How do they know what multiple to use? They simply look to the listed markets and they look to the transactions that are occurring. As I said, these people really are entrenched into doing transactions. They know what these assets trade at all the time. So they use that public market data to assist them pricing our unlisted assets. So really the value of our unlisted assets should mirror the listed assets or trading in the market and the transactions very closely. So really to summarise that, I'll say what we've got is a situation where we have independent business plans that come from the company themselves. They go to the independent valuers who make adjustments to the cash flows based on their experience if they see necessary. They look to the public markets and transactions to come up with evaluations and make sure that they are consistent, and they provide those to us. So look, hopefully that provides a little bit more clarity, and but look, always happy to take additional questions on that, follow-up questions, because it is something, like I said, I'm not sure the industry has done a great job of explaining how it's done.
Thanks, Andrew. And just to dig into valuations a little bit more, if that's okay, because there are a few more questions that come in. Can you just touch on member equity for people in between valuations, member equity for switching investment options or entering or leaving the fund, and whether that opens up arbitrage opportunities?
Look, with the periodic valuations, it is something we are very conscious of. So if I'll look at the current COVID-19 situation where equity markets were dropping a lot, there was a lot of concern within our team to make sure that we are reflecting fair value. So we engaged valuers to do out-of-cycle valuations. I did touch on, we got every asset valued as at 31 March. We also got many of them revalued at April, the ones which are more GDP correlated, like our airports, and we had even some done as at May. On top of, so look, we are trying to, and we are ensuring our valuations reflect what is occurring in public markets. We also typically, in situations which are not volatile like they are at the moment, we're not getting independent valuations done, we do roll forward the value of our assets on a monthly basis as well. So we know what the discount rates are in our portfolios. We do roll them forward every single month to ensure that those valuations do track what we expect the valuations to be at the next independent valuation. So that does really minimise any opportunity for arbitrage to be had.
And just to change tact a little bit, there's a question here from Steve about our registries. What are the registries? As he's observed, there's a big percentage invested in registries.
Now, this is a really interesting one. We own interest in the land titles registries in both South Australia and Western Australia. So every time someone takes out a mortgage or buys a property or needs to find a title to a property, they have to go to the register, and it's a record of all property ownerships in the state. So it is an essential service, and it's got strong monopoly characteristics that every time you trade property, you have to look to this register for the title. Now, what the government did, they've effectively privatised those registries. So the government sets fees that are charged for people to look at the registry. We maintain that registry effectively for the government. So we take a very small fee for each time someone needs to access the registry. And as I said, it is an essential service. So while it's not a physical monopoly, it is a legal monopoly that no one can replicate these registries. And it provides essential service to the community for any trade in property.
And there is a few more questions, but we are starting to run out of time, so we'll perhaps get back to those questions individually after today, and I'll hand back to you, Mark.
Thanks, Will. And we are very, very keen to make sure we do answer the questions, so we'll take the opportunity to either answer them through the BDM team by follow-up. That would be good. So, Andrew, maybe just in closing out the questions and answer piece, any final words on infrastructure from the manager's perspective?
What I'd probably wrap up by saying is that Sunsuper has been investing into infrastructure for 23 years now. We're actually one of the first direct investors into this space. There's probably very few superannuation funds in the market who have much experience as us as investing into infrastructure. Over that time period, we've built up a portfolio of core and core plus infrastructure assets, and that's not a portfolio you can replicate today. Many of these assets are quite tightly held. When they do trade, they typically go to the existing investors. We've also built relationships, as I said, with who we consider to be the best managers in the market, and we work closely in partnership with them. And we've also built up appropriate skills in-house to allow us to identify risk and mitigate risk and price risk, because that's effectively what we are doing as investors. We're pricing risk. And what this all means is that we believe our portfolio will deliver both those defensive characteristics of yield going forward, but also that upside from capital growth for many years into the future.
Thanks, Andrew. Also good opportunity for us to wrap up the webcast now. Time is knocking on the door. Andrew, appreciate the time that you've spent with us today, and we look forward to any other further questions and answers that we'll direct towards you. Big thank you to our listeners. We appreciate you joining in and obviously sharing questions with us and being interested. We're very keen to make sure we keep you up to date with what's happening at Sunsuper, both from an outlook, a services, but also very importantly, as I mentioned a wee bit earlier, just in terms of being open and transparent about what's happening in our business. You and your clients are most welcome to look at our dedicated web page. You'll see the link on the screen as it is there, and there's a lot of material that we'd certainly encourage you to look at. Please don't miss the rest of our deep dive series. We've got some exciting segments still to go, and again we'll go back to looking at around the objectives, construction holdings, and also the performance of our various asset classes. You can expect out of today an email that will have a copy of this recording, so you're most welcome to view, share as you wish. There'll also be a registration link for the other webcasts, and there'll also be a set of instructions for claiming CPD points as well. So thank you again, listeners. We appreciate your time today. Goodbye now.